Welcome to the Independence by Design podcast, where we discuss what it means to be a business owner and ways to get unstuck from the day-to-day so we can design a business that gives us a life of independence. What's up, everybody? I think you're going to enjoy this conversation I had with Tom Walker. He is from Walker Insights. He was the third segment on the quarterly economic and M&A update I put out a couple weeks ago, and Tom released a new article he wrote, and it was about why should you even plan if the plan is going to get broken. And I read the article, and I really liked it because Tom and I had a funny exchange about Mike Tyson's quote about everybody's got a plan until they get punched in the face. So why plan? But Tom then had a rebuttal on Twitter that he said, well, you're going to get punched in the face, so best to have a plan. And so why today is important and what we're going to dive into is Tom is really, really intelligent on how the growth of equity needs to happen for all assets. He spent a lot of his time in the agricultural space in Minnesota, but also with manufacturing, and the return on equity has to be above and beyond effectively 12%. Michael Saylor talks about this, where we have 8% money supply growth every year and then 4% inflation. So we need to be growing at 12% to stay in the same spot. So planning is essentially having the right goal, and we need to make sure we have a very clear understanding of our right goal and the constraints that we have, so we can better understand the decision-making framework that we have between the trade-offs of time, more cash flow today, or more equity tomorrow. So what Tom and I were talked about when I had him on the show is like understanding what our goals are is so paramount, because then we can better understand how to use our constraints. And we have to understand the constraints and the true nature of essentially capitalism, so that way we understand how to use our business to get us there. And I think Tom is got a really cool way of articulating what's going on in the marketplace, how the Fed is and the printing, and then the economy, and just all the stuff that's going on. So this is a very fun conversation I had about what is planning anyways, why the hell plan if you're going to get punched in the face, but if you get punched in the face, how do you have a plan that helps you pivot? So anyways, I hope you enjoy it, and check out Tom's material on Walker Insights. And if you want to know more about him, check out the show notes below. Share it with a friend if you enjoy it. Thanks so much. We were just talking about planning, and that's why I said, what you might as well just hit record, because this is the point of our discussion today is planning, and like planning yet. Like you were saying, that entrepreneurs, you're sympathetic to the entrepreneurs because they have, they don't necessarily understand the plan or have a plan. But then also, there's the difference between taking orders, but there's this assumption that there is some grand plan when a lot of times there isn't a grand plan.
That's fair. Yeah.
What made you write the article, Tom? Like, what was because it was so fascinating. I really liked it a lot.
I appreciate that. Well, it's just, I mean, obviously, we all think that we have something to sell and then we want to sell it. And so my long career has been in financial economic planning and everything that goes with it, which includes historical analysis, risk assessment, statistical tools. But the idea is to help people map, with some reliability, map a course into the future. And what's always surprised me is how little interest people have in doing that, or even how much actual resistance you get to that. So I try to understand, well, what are they really talking about, and why wouldn't they want to do it, or why do they think that they're already doing enough? So the quick essay was just a rumination on, all right, what are good reasons to not plan? What are good reasons to not involve the sorts of people who have the technical facility to help you plan? And
what were your conclusions?
Yeah. I think we people in my position, which is spreadsheet dorks, financial experts. I use the term advisedly, but people who are supposed to know finance and econ. We pretty easily forget that we aren't actually running the show. We're just keeping score, and we're helping to hopefully keep score prospectively, so people kind of know what they look before they leap. I guess there's another cliche for you. So it's been my work, and I certainly am attached to it in the sense that I've been doing it for a long time. I've been doing it for real people in real life situations, and I've seen what it does for them and how they come to depend on it, and how they come to be able to actually sleep at night, because they can put all sorts of unknown they can put all sorts of unknowns to bed. They don't wonder what they missed. That universe of things that you really can't control and that you can't know in advance. A good planning process really shrinks that. Makes life easier. At least that's the goal.
Yeah.
I think that to talk to the people I work for, that does tend to be the case. But it's also profoundly uncomfortable because at some point it's I'm proposing to hold up a mirror in front of someone, and it's not so much so that they're ugly, but show that they're inconsistent, and they have to confront themselves. I really have no skin in the game other than I want them to succeed.
I'm super fascinated in how you worded some of those things, but then Tom, like diving into how you worded um the article was fascinating to me. And I'll try and put some context but to why. So like
Yeah.
you said that you're not telling people what to do, and I say that a lot too. So there's a lot of consistencies of what you're saying and how I'm saying it, and then I think how we both think about the bigger macro economy and how like honestly the world works and money works and business works. And I found it very fascinating, which is why I wanted to have this conversation where if we're effectively just looking at the mirror, is the mirror to you like what their goals are? So like their inconsistencies are just their inconsistencies of their actions towards their goals, because that's how I've worded it in the past too. So I'm curious of what you mean by that.
Yeah, I think that's fair characterization. Maybe there's more to it, maybe there's less to it, but that's a pretty fair overview of the mirror I want to hold up is all right. You want to be someplace, um, and you're taking these actions now, and in what sense are they going to get you there? In what sense are they at least suboptimal, if not in
Mm-hmm.
fact contrary? It happened. I
Mm-hmm.
mean, yeah, long time horizons, complex business, competing sources, competing uses of your resources.
Mm-hmm.
Um, yeah, it's no mean feat to try to map that, even for a $10 million, let's say, manufacturing firm or a family farm. It's a big deal as you look 5, 10, 15 years into the future. So I think the idea of planning is to get a lot of detritus out of the way. Honestly, stuff
Mm-hmm.
accumulates. And sometimes people will state their goals in a way that's already couched in terms of what they think is possible. Um,
Give an
and
example, maybe.
oh gosh, how concrete can I get? People think that they want their business to be this is really crude, to be a certain size within 5 years.
$100 million. It's a great number that people throw around these days.
They'd like to, yeah, yeah, and or even just triple in sales or something. All right, so that's
Mm-hmm.
fine. But actually, what they would think they could do is to quadruple or go to 100 million. But they're willing to allow that their goal is 20 million because they imagine that that's all that's possible. And they may indeed be right. I mean, my assumption is not that people are running the show with these firms are stupid. My assumption is that they are the true foremost expert on what's going on. But it doesn't
And
mean
value creators too. You know, it's
value creators. Yeah, but it doesn't mean they know everything that might be useful to them. Um, but again, so the process is you do end up having to look in the mirror and what you're holding up your actual goals, what you're willing to admit your goals are against your actions, the actions that you're taking, and it's kind of uncomfortable. I think the one thing that bothers any of us is to be shown to be inconsistent. Um,
well, which is fascinating to me. Amen, because like cognitive dissonance is really painful for people mentally. Like it's a mental pain that's like it's anguish,
totally.
and like so. I love where we're headed with this because like and as we continue, I just want to plant the seed. Like I want to talk towards the end or however, cause there's some more groundwork I want to lay, but about planning in itself, but I think we're headed in the right direction before we come back to like what is planning, the pros and cons of that. But like, because you and I talked about the definition of a framework, but before we get there, Tom, is like you talked about these constraints and these resources and being inconsistent or where you're wanting to go. I believe that people have a clear idea of like they like, and a lot of the people that I work with, who are the people that you're also working with, are visionaries to say, I have an idea in a picture of what this could be like because I see the opportunity. I'm talking to people, like the product pricing fit, or whatever it might be. But then I think that a lot of times that what is missing is the actual constraints to get there. Like, and so I want to hear your definition of what are the constraints. So let's say that maybe there's this product pricing or opportunity fit or whatever it is, where like we know that there's market demand for whatever it is the hell we're talking about.
Yeah.
So what is it that are the constraints that are most people are blinded by that would make their inconsistencies visible for you?
Well, as you mentioned something which is something less of an issue in agriculture, being a commodity business mostly, but you mentioned product pricing, and wherever you've got at least a semi-unique offering, I think that high talent individuals often they are underpricing their best offerings. They're
Mm.
actually not and outside of broadly traded markets, you don't have anything like price discovery. And I think in let's say in a kind of
You can describe that for the listeners, because I think that's an important type of the price discovery. What do you mean by like? Because I think that's an important factor that's different between the smaller markets and the bigger markets.
well, yeah, I mean, price discovery. Everyone knows what USDA number two yellow corn is worth today, tomorrow, 3 years from now, and 5 years ago, or at least
Mm-hmm.
what the nominal price is. Now,
Mm-hmm.
it's undifferentiated product, and it's barely edible, and a lot of it goes into ethanol, but that's a different topic.
Oh, that was great. Okay,
So,
yeah.
yeah, I, I do have opinions. I just try to keep them to myself for the sake of uh, the person's actually paying me for actionable advice. Now, price discovery is, I mean, if you're a custom job shop, and you're going to bid for a lot of stuff, and you're basically a professional full-time problem solver in terms of making parts, making
Mhm.
mechanisms, casting things, bending, forging, stamping, whatever. Um, it still is unique. You still have a unique offering, but frankly, your price discovery is limited to your internal ability to make something efficiently. So you're using your costing system, and you got a cost plus model. Well, that's actually
Either that, or don't even think it's like talking to your salespeople who have confidence issues. Or you're talking, they're talking to their
oh
suppliers who are throwing their weight around. I mean, it's just anecdotal bits of information, right?
yeah, it's very disjointed and anecdotal. And of course, at the end of the day, I do a request for a quote, and I either get the job or I don't. And there's your data point. Well, it's pretty narrow, although honestly, one of the things I've found in that space is the people that even the data that they do have, and anecdotes actually are the plural of data. I think
Interesting.
if
Yeah.
if you
Yeah.
actually track that stuff, you actually have a sense of where you are vis-a-vis the market. And it's a really challenging product, but if you have a firm that's been around long enough, you actually can create an internal pricing model. It depends on what their data set is, but I've been able to do that on occasion where I create internal price index that ends up being fairly comparable to market conditions.
Cool.
And I mean, it's a huge job. I think it's in manufacturing, it's low hanging fruit. Honestly, um, if you look, you will benefit. But it's a lot of work, and it feels at the first, for the person who's paying to have it done, it feels very speculative. So
Mhm.
that's one of the reasons it's very low hanging fruit. I think everyone looks at it, they look at the cost, what's involved, they're uncertain as to the immediate benefit, therefore they don't do it. Therefore, the advantage from having done it is massive. Um,
Mhm. Mhm. So,
uh,
so you're talking about like, which is very helpful, but for price discovery, and I think that, and actually, it's really interesting. I just had Casey Brown, who's a pricing specialist, on the podcast, so people can go back and listen to that. She's been doing it for 25 years. You should get to know her. She's fantastic.
I will.
Um,
I noticed that pop up, and it caught it piqued my curiosity. So
yeah, she's no
I'll give it a
joke.
listen. Yeah.
She's the real deal. And so price discovery, meaning that like, what is the true value of what you're doing? So when we were talking about then constraints, so like someone has this vision of like what could be, and so they're relying on their gut, their anecdotal data, whatever it is. But let's assume they're roughly right for like what the market demand could be, and then you're trying to, and that's what I also help people do too, is like it's to unearth the inconsistencies of their understanding of the constraints to get from here to there. So like what kind of constraints do you see help people think about to make a better base case of reality?
Well, I think we might have touched on it last time we spoke, but as you know, a lot of my work is in agriculture. I work for farmers, for family businesses, um, and these are not small concerns. I mean, a commercial scale farm in Minnesota, the ownership is going to have $30-40 million in assets under management. Some of that's via lease. I mean, leasing
Mm-hmm.
farmland, and much of it is also via actual ownership. And on $40 million of assets, they might generate a top line of 5 million, and in a really good year, their EBITDA might be 1.5 million. So yeah, I mean, you've got razor thin margins. It's a good living. It is possible to create a lot of wealth, and they in fact remain a very high net worth segment of population. Farmers do. So
Mm-hmm.
obviously it works, but it's really daunting when you look forward. But the really simple thing is, it's understandable that farmers, one of their long-term visions is to actually own a fair amount of land. I'm a
Mm-hmm.
farmer. I mean, I farm land, ergo, why wouldn't I want to own it? The
Mm-hmm.
near-term constraint is that, well, farmland, in terms of, we talked about returns on capital, is a
Mm-hmm.
very, very, even historically, it's been low. And ever since we divorced from totally from gold in 71, it's been insanely low.
August 15th.
I Oh, Bill, you got me beat. I didn't know the actual date was 71. But you see so many things, frankly, go batshit after 71 in terms of volatility and predictability. Farmland being one of them. But even prior to that, it's always been a somewhat lower return asset versus well, let's see, I can plow my asset base into owning farmland, and I can only make it to 2,000 acres, or I can um, put that into logistics, storage, technology, and then I
Mm-hmm.
can handle, assuming that I can find landlords, I can handle 10,000. If I can find landlords, of course, your return on assets as an operating farm, if you're doing a good job, is 10-15% consistently. In farmland, at best, you might be looking at 5 or 6%. And with kind of the money print orgy that we've enjoyed, or some people have, I haven't enjoyed it.
Amen.
Yeah, that we haven't that we've been seeing since '08, since 71. I mean, it's been ratcheted up at several points. Um, the return is 3, 4, 5%, and so you're I want to own land. I can't own it on these terms. Part of the planning process for me, specifically working for farming, well, I'm not going to question your goal. We're just going to question the timing, the means, and what your trade-offs are. And that gets to be really interesting because you do have a fair amount of long-term volatility in the economy, as we've talked about. I
Mm-hmm.
mean, interest rates go all over the place. It's gamed by the Fed, arguably. They suddenly buy a lot of assets. They get involved in mortgage-backed securities, and I think that that's certainly rippled through the larger asset-based economy. Um, it's a complex amount of calculations, and not only can you sub-optimize without meaning to your path to growth, your path to your actual goal, you can end up really setting yourself up to get knocked out of the game because you missed time on asset purchase, and then things move against you, right?
Which are the constraints, and it's really, so let me throw this framework of thinking, before we talk about frameworks for planning, but I
Yeah,
think about thinking, this will be interesting time to build off of. So like I've got this triangle, which is what I call the ownership thinking. And I'm talking about ownership of assets, which is important because we're not talking about operator where that's a job. But
yeah,
so I have time on one part of the triangle, and all I want is independence over my time. And I think that's what everybody, as a human being, our base case, that's what I think most people want is independence over their time to do whatever you want, pursue your passions, hang out with the people, the whole like purpose driven. But then we need cash flow decoupled from our labor to have independence over our time. And that cash flow decoupled from our labor can happen over time, but we have to go from labor to ownership over assets, which is dividends and distributions of varying different types of assets. Our privately held business becomes one of the best ways to accomplish this. And then the third side of the triangle is equity, where we want more time to generate more cash without our labor, generates more equity that frees up our time. And it should be the self-perpetuating flywheel upwards. But the constraint becomes time and capital. I mean, which are the kind of the same thing.
Kind of the same
and
thing,
you
yeah,
and I,
exactly.
and you and I have talked where like the Fed, by increasing the money supply, is stealing our time. When we technically wouldn't need cash flow if we actually had assets that, or money that didn't get, debased. It's because effectively we're like where I've landed. And then therefore you go, okay, well, what are the constraints from going to point A to point B is outrun the goddamn money printer and make sure that you've got enough. You've got the vehicle, which is your business, that can generate enough sustainable cash flow and return on assets to get you there, so that way you don't get outrun. I mean, how do you think about that?
No, I think you're exactly right, and it's a real challenge. I mean, one of the things that people like to we all want sort of safe harbor, and it kind of doesn't exist, especially in a fiat economy. The reality is, for someone who has been blessed with the ability and the opportunity to run their own business, that's about as safe a harbor as they're going to find in terms of being able to outrun the money printers.
And describe safe harbor for you, for because like in your definition, because I'm tracking you. I just want to make sure everybody listening.
Sure, I'll do my best. Sometimes I say words and boy, I guess I didn't really think about what I meant by that. Yeah, it's what assets that are safe from depreciation, assets that will continue to buy what we imagine they will. They will continue to buy
Purchasing power.
in 10 years what we can buy with them today. And people understand that even as passive investors, they need a certain level of retained capital to grow the investments, so that what they leave an inheritance, so that they have room for volatility and the unexpected and all of these things. So safe harbor is well, I can retire on this much money today, and I'd like to think that I can retire on that.
Well, which is why I love. Thank you for that. And what I think is so important is like, if we can't outrun the money printer and the money supply growth, which Michael Saylor, CEO of MicroStrategies, I've been following a lot. You and I've talked about him. He called it, 7 or 8% money supply growth each year, and then 4% inflation. I mean, you're sitting at a 11, 12% growth rate to stay in the same spot. And like, if that's the case, the money growth is stealing our time. Effectively, is what is happening from people. Is like, you work all that, but then you have to, back to your point, you have to get back on the treadmill and outpace the growth, which is insane.
Yeah. And as an expert in your business, you have a shot at doing that.
Right.
People have talked about selling out because they want to take their money off the table, and I get it. I hear them. It's, well, dude, I'm all for retiring and taking it easier, but you're not taking it off the table. In fact, you're taking it off the table that you actually know really, really well, which is your business, and putting on a table that most likely you know a lot less well, which is some range of investment strategies. It's a daunting task, and the good news is, for people who are still in building mode or have no interest in letting go of their business, it is the best. I think it's about the best inflation hedge out there.
Well, this is so important of a conversation that we're having right now, because as I've seen the light behind this concept, Tom, people like, that's why I built the Independence by Design framework, because it's the ownership. It's essentially the PE playbook meets the family office playbook, so the person can get out of their freaking job and then actually take some deep breaths because someone else is running it. But there's a framework of financial models plus goals plus visibility and education to say, hey, I can actually take a step back and not just guess and hope that Tom's running my business correctly, but they can manage it like a PE firm would. And I say all this because, like, I went through this decision tree, and I think this goes back into your return on assets equation. That's so damn important. Should be the right metric, not just revenue growth. But it's like, okay, so you're going to take your, let's say it's $1 million in normalized EBITDA, but after taxes and all, let's say it's 700 grand in free cash flow. Like you're able to take 40 grand a month in distributions.
Yeah.
Where the hell are you going to get that level of return in the marketplace, which like was something that you know as well as what you do right now? I mean, there's obviously subject to like you have industry risks where like your company potentially is sacrificed, but let's assume that there's not, and it's a needed, valuable service. You go, holy shit. Okay, like and like you and I talked about this. I can't even remember what call it was, but like the build-up methodology that is the weighted average cost of capital is this. That's what we're talking about here. You go through the decision tree and you're like, holy F, I literally got to stay doing what I'm doing unless all this disappears like over time.
Yeah. And so people can feel trapped too. But it's interesting, right? As to your idea of the founder, owner, entrepreneur being able to hand over the reins, at least in part, to have someone actually do more work, and then they get some of their time back, however that works. I think one of the prerequisites is what you call a framework, and colloquially I call it planning. I think when you have a business that has they have a meticulous habit of planning and a fairly detailed and a careful documentation over the years, you actually are also creating a path for, let's say, professional management to follow, to be able to run it according to your vision, which is the only vision that's going to work in a firm. You give them a template, you give them value, and you also create the means of monitoring your business without having to be hands-on all the time.
Agreed. And I think what's so fascinating, Tom, is like, okay, so like the relief that people get because they actually have like a playbook for someone else to follow instead of like in their gut, just kind of like, God damn it. Like if I walk away and don't call Tom, I'm literally just hoping he's managing the right stuff, but I didn't even know if I was managing the right stuff. And you go through this whole, which is just stressful. And if you're stressed, you're not, even if you're not in the office, you're not going to be, free because your mind is still there. And so like one of the, what kind of going into the word planning or framework. So like here's why I thought it was so fascinating when you and I were going back and forth with our emails is like, and I had another conversation with someone about EOS or traction and the planning and the 10-year, 5-year, 3-year, 1 year breaking down to quarters. So I want to articulate my thoughts about it and see, and I'm concerned about priming you, but I feel like you knowing where I'm coming at will be better to hear your feedback on it.
Yeah, I'm curious to what you have to say about EOS.
So like
EOS.
Mike Tyson's quote, everybody's got a plan until they get punched in the face. Or I've also heard, men and women plan and God laughs, or whatever the words are that you use. And like, that's why I liked how you approached the article is like the fallacy of planning. However, I also believe, we can't, and I think this is actually the problem. Well, so planning in definition. So I'm thinking out loud. So bear with me here, and I'll try and land this plane. So planning is a slippery slope. I'm just about done with Frederick Hayek's The Road to Serfdom. Awesome. And like it's an entire book about how like planning and central planning is, because it's this vicious loop. It's like you take one step and you slide right into communism and socialism. It's like, okay, well, because everything is about planning because there's supposedly this perfect answer for everyone. And then you have to push down people to plan for everyone. And so his whole book is about like, even just the rightest intentions are paved. The road to hell is paved with the right intentions. However, we got a plan. And this is like the weird dynamic of you hear the rational person go, we have to plan. And I agree. But like where I land on the word framework was like, I have goals of freedom of time, cash flow, and equity. So that way I can be anti-fragile, like Nassim Taleb talks about, where it's like, okay, like I essentially don't want anybody to tell me what to do, and I want to be like I want to be a sovereign individual with a voice of what I want, and I think a lot of people do. But the vehicle, the business, the vehicle that is the surfboard that's managing the wave of chaos. And like
Yeah.
I still have to like practice and plan, but like I don't know what the hell is coming out of my mouth, Tom. But like there's this weird dynamic of like planning is important, but it also leads to communism essentially if we go too far. And is it the unsound money that creates that, or like what? But like there's some, but like I agree. And this, are you tracking me
No, I get it.
with the planning? Like it's so. Like, where do you find like what is the root foundation of how to plan for the unexpected, but
Yeah.
navigate through the unexpected through a framework or a plan? Like, where do we?
Well, part of it is knowing your history, and it's knowing firm history, um, and so you kind of know what can happen. Um, I mean, it's a bit like low grade Chestertonian, but I always say if you don't plan because you can predict what's going to happen, you plan because you can't. You have to have a means of navigating of judging the deviations from expectations because it will every time. And I think that there's a muscle that gets exercised, so you end up being it's planning is more about preparedness, let's call it, than prediction. It is a framework question on
Where do
plan.
you think that gets lost? Because I think I look at the central government right now. It's like you can't plan for everybody. Everybody can't be equal. We want with the equal playing field, which would happen if we had sound money. But like
Yeah.
I know, like so, like but like where does the definition of planning get lost? Where you're trying to predict everything perfectly for everything.
Well, it certainly is. I don't know. I think people want certainty, and it's not there for us, but it is still possible to test your actions and their impact in the future over a range of possibilities, so that you avoid unrecoverable mistakes, so that you make the best use of your resources, so that you have reasonable expectations that over time, given the volatility of the economy, that this will keep you ahead of the fiat treadmill. And so it's more about it. There's a bit of statistics. There's a lot of judgment. But if I'm working in farming, just because the data is fresh in mind for me right now, but I know what their yield history is. I know what the interest rate history is. I know what the relationship between that and commodity prices is. Because I've been working with these entrepreneurs on plans for years and years. I also know how closely they can follow a plan. Some of it's very closely, some of it's a bit more of a crapshoot. It depends on how much
Mm-hmm.
control they have over the factors. Um, well, given that sort of a history, I can look with them 5 years into the future and say, well, what are we dealing with? What's the best play? What's the play that has too much downside and not enough upside? What's the play that is unlikely in terms of upside, but the upside, if it hits, is huge, and the downside is minimal. I mean, so it's kind of there's almost like a perpetual kind of a tail hedge mentality. Um,
Yeah, I like that a lot. And just for the audience that might not be familiar with it, what tail hedge? Because I love that too, since I learned that model and that
yeah,
concept.
well, it's kind of like insurance, basically. It is insurance,
Yeah,
and
yep,
it's essentially what
love it.
insurance companies are supposed to be doing for us.
Supposed to be. I love it. Words matter, right?
Yeah. Well, and they are, but of course, their problem is in a very stable, unstable environment with fairly speculative asset valuations. That's the only way I can call it. All right, they're going to take our money and they're going to invest it. So then when we have to pay out some of it, they'll still be a little bit ahead and they'll be able to keep doing
Yep,
business in the future. Well, yeah, try to chase that stuff down. It's horrible. Their exposures are intolerable.
yep,
Um,
yep.
and I don't want to comment on general asset price or market conditions, but when you look at asset prices versus their cash flow generative possibilities, very few things make any kind of historical sense. Um,
Well, yeah, I mean, like, and I actually, so back to just for the listeners, what you're talking about is, I mean, because people have been hearing me talk about the cash flow valuation. People can go back and listen to Ken Sangenario's episode I did where we talked about the multiple and where the multiple comes from and the weighted average cost of capital. And it should be money should be getting kicked out of a machine that is sustainable, predictable, and transferable, that is as lowest risk as possible, so you can increase the PE ratio essentially, which is the multiple and over the EBITDA. And I say that because it should be a flywheel going up where the larger the multiple, so the de-risk the machine, the higher the cash flow, and then which creates more de-risk. So it should be this flywheel upward. But like back to what you said about the public markets, Tom, it has been effing insane. I have been down this rabbit hole now for 10 years because after we sold our business, we had to go put it into the markets. And then I was in wealth management. I got my securities license back in 2014 for a hot second. And I hated it because people would be like, what do you think of the economy, Ryan? And then I would be like, so next thing you know, 10 years later, I actually have comments about it. But like, what's so bizarre is like these companies, like you could have a run on the entire stock market. If everybody needed their money back, there's not enough money for everybody. It's effectively a fucking bank. You just feel like, no, like this is all like they printed the $5 trillion and all the asset prices went up, everything. And you go, okay, well, this is what everybody's holding it, but there's no cash flow there, really.
Yeah, well, that's my mind on it, Ryan. And you know, you can say, well, the sky is falling, and in the meantime, everyone's levering up and getting wealthy, and I, speaking from experience, look like an idiot. But I don't like the play if the play doesn't make sense by time tested business metrics. I'm not interested.
Because your play is trying to generate more cash flow.
It's cash flow. It's return on assets. It's as much as possible anti-fragility. There, you know, the hunt for the next greater fool. You can make a lot of money if you know how to do it. I don't. I'm not sure who does. Uh, you know, you look at the farmland equation. You know, in Minnesota, I don't know, 4 or 5 years ago, farmland was selling for $6,000 or $7,000 an acre, which relative to cost of funds, relative to income produced, was way too high. So don't buy. In fact, if you're thinking about anything, use on spec. If you want to speculate, short it, sell it. Well, what happens? Well, government kicks the printers into overdrive. And
third shift.
Yeah, yeah. Now it's worth 10,000. No, it's selling for $10,000 an acre. So you look at the underlying, and the reality is that it's always possible for an irrational market to become even more irrational for a while. And
for a while.
And the most trickless farmland, you know, and of course, working for farmers, I said something about what I thought it was worth and what was likely. So, you know, for each operation, I went and back tested. All right, what if you would have bought for 6,000? What if you would have bought for it and then enjoyed a paper gain? And because that's all it is, unless you sell it, a paper gain of $3,000 per acre. What's the what's your net worth impact? What's your cash flow characteristics? Well, yeah, it had a positive net worth impact, no surprise, but actually it had tremendous stress on cash flow and working capital. Yet, even assuming that you were right and you could unload it, the problem is the net worth needle. You didn't move very much, but the risk needle really spiked into the red.
It's so well articulated. And so I want to give you my parallel world example that I'm currently in the midst of for a couple clients, Tom. So for the listeners, when you're saying paper wealth, you're talking about the net worth growing, but that doesn't mean the cash flow grows. And so like I have been promoting the cash flow equity valuation as the target that everybody should be marching towards.
Yeah.
So you're talking about taxes, debt, and can your company, here's how I've got this mental framework with Thomas. Can your company, regardless, I know SBA loans top out at $5 million right now, but just this concept is, I think, easier for people that are not in finance to understand is 120 months, 10 years is an SBA loan. $5 million for an SBA loan is $70,000 a month in debt service. Your company either can or cannot service 70K after taxes and working capital and growth and paying you or not. It's that simple. And
Yeah.
well, it's like, so then you go, okay, well, if someone's got, and you back into these numbers, Tom, and you go, holy shit, 10 years is a long time, first of all.
Yeah.
Interest rates, well, let's just say interest rates stay the same. And you just back into this, and like the amount that people have been paying for acquisitions in the M&A space that I've been doing, as I've been doing this for 8 years, I'm going, I would never want that. Like, I turned around a effing company where we had no money, making a $250,000 payroll every 2 weeks. And so I've got the skill sets where I've done this before. And I'm going, why, like, what is going on? Well, so then they're jamming either too much equity and too much debt. And I go, this is a freaking house of cards.
Yeah,
and I just go, like, what the hell?
It goes over my head, Ryan. I mean, I'd like to try to find. All right, I don't get what someone is doing. It makes no sense to me. But you're smart. The person who's doing it is smart. What is your play? What do you think is going to happen? I've never been able to find an answer that satisfied me. I mean,
dump it on someone else that's dumber than me sooner before the music stops. It's like, I'm putting paraphrasing.
Next greater fool. Yeah. And I think some people know how to do that. Most of them don't. Most of them end up being bag holders. And trying to predict the rush for the rush for the exits. Good luck. I think that gets into such random, complex calculations.
So, like, and here's how, like, to again, I'm continuing to pull in these metaphors, like, because cash flow matters. You're either providing a good or a service at a price that's sustainable, and you can pay all of your overhead, your costs, your cost of goods and your overhead and your taxes, and continue to grow and make a return that's hopefully 12%, or not.
Yeah.
Right. And like, that's how, like, it's really just that simple to me. And all the financial trickery and everything like that is to take the paper wealth that is accumulated from the money printing and dump it on someone else so you could monetize it, which is possible. It's just like the amount of risk of, like, I don't know when the music is going to stop. Or when, like you thought the farmland was going to stop at 5-6 grand. And now you're at 10, 12, and you're like, shit. Like, so therefore all of those people that were doing that were technically proven right. Yeah. Yet there will be, like, I just believe in gravity, Tom. Like, we're
likewise.
Likewise.
I do, but and so let's say you've made that play, and it's a spec play, and it's the highly leveraged one on the farmland question. It applies anywhere, but all right. And now what? Where are you? What's the nature of the advantage? How fragile are you? And what else might you have done with the capital? Even assuming that your play was right and you can find the next greater fool, it's not a super lucrative play. I mean, that's what I found out.
Well, and let's talk about why. Because, so let's say you did everything we just talked about. You found the next greater fool. Someone else levered up like crazy, or so either they piled a bunch of equity in and debt, and it still doesn't make sense for them, but they're doing it anyways because maybe it's not their money and whatever. But, like, you got someone else to give you a bag of money for that paper wealth, and now you've got a bag of fiat money. Now, what are you going to do with it?
Yeah. Well, what am I going to do with it?
Well, like, but that's what you say. Like, that it doesn't make it obvious that was the right choice, anyways.
Yeah. That back to your point. Yes. Now it's interesting. Business is very volatile, and certainly when you get into energy and into agriculture, and the reality is you have to assume that some years you are not going to make money, and your whole plan is to lose as little as possible and hold on to as much working capital as you can, because you don't have the luxury of jumping in and out on spec when you think you're going to lose. You've got relationships, and you've got people depending on you. It's not practical, nor should it be. And so one of the questions is, if I'm working with a business, we're going to lose money this year. Okay, it happens. Why? What's the cause? And then you have this whole exploratory thing that you stretch the planning time window further into the future. Well, We've got various factors, and we know how they tend to move historically. And we think that we will return to profitability, let's say in 2000, late 2025 or 26 or something. And then we maybe will look at the industry characteristics, and you can get really granular in agriculture. All right, what's the competition? How much? Well, they lost more. They have less liquidity, so we're still at an advantage. So we're okay losing. We don't like it, and my clients tell me so very loudly. They don't like losing money, but they also know that okay, that's the best
Versus
I can.
what?
Yeah, versus what? This is the
Yeah.
best I'm going to do this year, and I had the expectation that we will return to profitability under these conditions. So, and then it's just as a question of, well, you know your history, you know your personal data history, you know the economic geography. Um, you think a few moves ahead, and then you've got your financial structure, your working capital, such that you can hold on to your bank relationships. No one's going to fall out of love with you and give you walking papers before you return to profitability. Because that's what you don't want, right? A lot of the
Right.
question of planning is there's a lot of businesses that are sufficiently well managed and viable, but if you make your play wrong, you don't get to average out and make X money because you got thrown out of the game in one bad year because you had insufficient
You have too
liquidity.
much debt. You're like your working capital's out of
Yeah.
whack. Your vendors don't like you. I mean, like it just
It's just run down the list of things that can conspire against you to basically slam the door shut. Well, okay, now you now you're out is the whole idea of ensemble versus sequential risk. And of course, businesses are, insurance companies manage ensemble risk. That's what they do for those of us who can't tolerate a sequential risk, which is small business, right? We
mhm,
don't have any actuarial benefit to our size. We're too small.
mhm. Well, and it's well, and like what you're talking about is like the rainy day fund. Make sure that if you like need to shut off your distributions, you go to your bank, you hopefully don't have too much debt, you can weather the storm and you come out better than you should before. I mean, it's capitalism and it's creative destruction. And like my question for you, Tom, because like, I mean, and I've thought about this so much that I'm just trying to get a better understanding. Like, so I'm turning 38 next month. So like I graduated in 2009 from college. My college was a liberal arts St. John's. They didn't even talk about the great financial crisis, which is effing crazy. Like it was just like this talk about a bubble and like not, I mean like so I graduated and then I had to eat shit for 5-6 years in the family business managing that whole turnaround. So I learned
Sure.
real fast like
Yeah.
what reality is. But here's my where I'm going with my question. Like so 2008, you and I keep talking about these major milestones in the economy that where things have not, that things are different. We're like, so 2008, they hit the money printing, things go to zero, everything went up and to the right. So like, okay,
Yep.
so here's how I've tried to justify all of this shitty behavior. Is it like, so people that are 65 right now, that all started when they were 50. Or if you were 45, now you're 60. So like you're like the baby boomers, like the younger baby boomers in Gen X, it was a 15-year cocktail party where shit couldn't go wrong for the most part. And like
Yeah.
the way I've so like that's what has like precipitated all this bad behavior and do here are some of my questions for you who's been doing this a lot longer. Are people just not used to losing anymore? Like and they just don't know what it's like and they don't have a
That's
rainy day fund or
That's
what the
fair. I
hell?
mean, I know in the bank space, and I talked about, for instance, our friend Jeff Campbell, has great vision and judgment, and he's older than you, younger than me, and maybe not by much, but he hasn't seen a lot of stress, but he's got a good mind. So, but
Yep.
the reality in the banking space, loan officers, credit analysts, is people with considerable professional maturity. They've been at it for 15, 20 years. They've never seen a really significant a prolonged downturn. So whatever they know, their professional experience actually doesn't include a serious loss. It's
Eating
just that,
shit. And that's
yeah,
what I
yeah,
think is so fascinating about my story is like I like that's what I did when everybody else was having a heyday. Like and it was because we had a bad banking situation. We were financing our receivables. We had a bad, a lot of situations that went into while everything went up and to the right, we were dealing with unbelievable stress with our family business. So like I went through
Yeah,
all that when everybody else was like, "This is a great economy, things are great," and I'm going, like,
yeah,
and so and the way the other metaphor I like to pull on is like, it's like my habits of discipline for my morning routine are to keep my mind sane. But like, I mean, they're physical habits. And I remember sitting at the water cooler, Tom, and like everybody's like, "You just wait till you get old. You're gonna like." I'm like, "Wait a second. I'm just gonna randomly look like you who's eating McDonald's in the morning and smoking cigarettes. Like my habits will never allow me to get there regardless of my age." And I say that because all
yeah,
of like over time, habits and discipline just matter. And I'm hoping what we're talking about is that like there will be a reckoning where the people that have habits of building a good business, looking at their cash flow, looking at their return, there will be a reward for those people instead of people that are doing financial trickery essentially on the paperwork.
yeah. Participating either wittingly or unwittingly, it's certainly I've I've clients across industries, but certainly in agriculture who are they've grown, they've made money, and certainly in terms of risk profile, they've been able to get good returns on assets steadily when it was a real struggle. But at the same
Mm-hmm.
time, they're not as big as they'd like to be. They want more growth. They've got let's say they've got next gen is coming of age. They need growth to maybe be able to fit them in to give them room
Mm-hmm.
to
Mm-hmm.
stretch out. And there hasn't been any intelligent, responsible way of growing. And meanwhile, of course, they see people who are just surfing the fiat wave, um, and they're levering up and they're growing and they're crowding the stage. But
And or setting um the wrong target for the goal or creating the FOMO or whatever it is. Cause like, I
they
mean, I
are
have
they
people,
are yeah, yeah,
yeah, which just distorts all the conversations because like people are like, well, like someone in my industry got 100% cash from this. And I'm like, that is possible. So like, I don't want, like, I'm the most inherently opportunistic dude ever. Like, yet I'm constantly being like, but by like, I don't care what you do, but just like go in eyes wide open. So you're placing your bets according to reality instead of
yeah,
like the random conversation because like I mean these PE firms it's just these short-term incentives and levering up or like yes people are getting 100% money but that doesn't mean that you can engineer that as
yeah.
potentially I don't know it just
No, that's I lost the thread. Right, you said something before in terms of exactly where my mind is in opportunity and in terms of working with people.
discipline reality
Yeah,
coming in and
yeah. And part of the discipline is a fairly rigorous documented planning routine. It makes your credit with banks. It makes it portable. They love you because they can see who you are and that you are who you say you are and that you actually do what you say you plan to do. Massive credibility, and it means that if we have any kind of liquidity events, which are cyclical and inevitable, um, they're not going to be interested in flushing you because they want good credit. And when you've got a long track record that's documented, you're credible. And if
I know
people
I know exactly what it's like having the opposite experience of that
you're
with
well,
our family business. We were the uncredible one. That was we were. I mean, they were fine with us until they had a bad portfolio that got reckoned with in '08 and '09. The FDIC came in, put someone, our president, the president of the bank that was working with my dad, who was giving my dad perfect working capital loans left and right. All of a sudden, had zero responsibility at all. The FDIC came in and said, "We want these loans out." And then the next thing you know, it was a fight for our fight for banking for literally 3 years while there was no other banking appetite in the marketplace, which is why
yeah,
actually I know Jeff Campbell because like that's
okay,
how I met Jeff.
okay, well,
And I say that because you're right. Like, had we been able to have our shit together, explain what we're doing, where we're going, why we need it, what we're like, people like it's just yeah, it just is so.
it ends up being a lot of waste, which is the sad thing. You end up with people who are themselves decent people of considerable skill end up dealing with all sorts of trouble and loss that could have been avoided. And that's going back way back when my dad started this process when I was far before I came of age. That's what bugged him. And one of the first questions, when back in the 70s and 80s, when turnarounds and workouts were far more common, they'll probably become common again. But he had two questions for let's say a lender asks us to help with a client, a troubled client. And two questions. All right, are they a skilled farmer, manufacturer, or whatever? You name the industry. Are they a skilled farmer? Do you trust them? If the answer to both are yes, then I don't care what their recent troubles are or what the hole that they have fallen into is. We can find a solution if we
Hmm.
have the will. Um, but that's an unpleasant process, and a lot of it is, yeah, guys, it didn't have to look this way. All the stress and all the financial setback, let's say, um, it didn't have to look this way. And what was missing? Well, presumptively, a process that enabled them to think a bit more clearly, a few more moves ahead, to avoid those mistakes that were potentially non-recoverable. Mistakes are inevitable.
Which is back to your planning, right? And like, so like when you're
Yeah,
thinking
yeah,
about when you think about planning, Tom, like, so like if you have here's how my brain works on this, I'm curious on how yours does. It's like, okay, if you have a pie chart of 100% probability, and then you break it into different probable outcomes, say, okay, like then this is where they like, trying to reconcile someone's inconsistencies. It's like, okay, well, first of all, your goal has to be like, we have to unbelievably clarify your goal, because you can't say you want this and this because we have to use your resources in one way. Right. But like, and so it's like reconciling that goal, unbelievably making sure it's unbelievably clear. But then how do you like, what kind of inputs are you looking at? Like, how are you stress testing and coming up with those output of like different probabilities of different outcomes? I mean,
yeah. I mean, obviously, it's a spreadsheet process, but it's a dialogue and it's iterative. So you're running scenarios and then looking at actual data and then updating. Um, I don't know if it's a sufficient example, but if a farmer's sizing up buying land for $10,000 an acre, we can all do our back of the napkin calculations. Yeah, that's dumb. Don't do it. Okay, don't do that. This person has something in mind. Show them the respect as human beings. All right, what do you think this is going to do? Why do you need it? And where are you going with it? And
Mhm.
um, look if
And at
most
the end of the day, when you say that, and then you're just building a cash flow, because this is where I think when you and I first met, it was like the 3 statement model cash flow forecast. It's like
oh
it either
yeah,
cash flows or it doesn't, right? You
yeah,
either can
what
afford the working capital and the cash flow and the equity growth
yeah.
or not, right? Is that the
And
kind of the base case?
can you afford it? Okay. Do you want to afford it? Where do you want to be? Where does this put you in 10 years? Does it put you out of business? Or under what circumstances does it put you out of business? What do you think is going to happen to make this pay? I want their thinking, not mine. So
Mm-hmm.
how's this going to work? Now, if someone is going to spend $10,000 an acre and they're just going to raise conventional corn, soybeans mix on it in Minnesota, we can look at long-term trends. We can look at yield trends and say, yeah, this isn't going to work for you. It does not going to work for anyone. And in fact, it's going to erode your wealth, not enhance it. Do you want that? Now, on the other hand, if someone has figured out how to successfully raise, Cabernet grapes in Minnesota, that's a whole different look. I don't think anyone has. I'm not a
Yeah, I don't
vintner,
know. I'm thinking about a couple of wineries. I've always wondered how the wineries make it here in
I,
Minnesota.
actually, I'm told that they're doing all right. They're doing they're doing okay. But
Interesting. But to your point, just translating it to even operating businesses, I mean, like you're either the increased payroll, your machinery, buying that. I mean, like you're just running through their strategies and saying how much are they going to cost?
yeah, yeah,
What's the return on equity and assets, and then also can you cash flow your distributions and the business? Like,
yeah. I think it looks different in Well, I know it does. Manufacturing has the advantage, if you want to call it that, of they have more swings. I mean, if you're a custom shop, you can always try to fix it with the next job, with the next customer,
mm-hmm,
and your time horizon is narrow. And that's one of the blessings is um, Well, you have more chances to get it right. Farming, if you got long production, you got 40 swings and you're out, or something, give or take, whatever,
Interesting.
right?
Yeah. Yeah. Yeah.
Um,
Yeah.
whether you're raising animals, most of them are a year to two to maturity, and the crop is you get one a year in the state. Manufacturing, you've got 30, 60, 90-day cycles, and that can be an advantage, but I also think it makes them too myopic, and they do lose sight of the forest for the trees. Um,
That's interesting way of articulating that. And I would say that that's one of my missions is like, let's look at the forest. Like, what's the goal? Because like back to your earlier point in our conversation, like they have an unbelievably unique ability to do pricing discovery with all of that volume to
yeah,
pivot, to move, and to grow. Like you talk about the vehicle to outpace the fiat bullshit and like to actually have an asset. Like middle market businesses, if you have good customers, like you don't have 40 swings, you got thousands a year potentially.
yeah. It's and now, of course, just the wealth of data. I think you can lose sight of it, and I think that you end up being you don't have a broad enough view of your own personal history, even much less economic history.
Mm-hmm, mm-hmm,
At least that's been my experience. So, in terms of bringing a planning framework to those businesses, it's to essentially try to help them force a much longer view, which
mm-hmm.
feels like a time waster because they got stuff they can fix in the next 30 days, and I'm asking them to think 4, 5, 6 years out. But
It's
demographically,
hard. Yeah.
it's changing because a lot of these firms are headed up by very experienced, mature people, and they're older than me. They're north of 60. They're pushing
They're
70.
tired. I'm watching that, Tom. Like I'm hearing the word tired a lot more than I used to.
And yeah, and their businesses aren't as ready to sell as they could be. And I think what happens is essentially for failure to document your business and to have a planning routine, you're changing the kind of buyer that is going to come in if you have a buyer at all. I mean, if you've got a plan, if you've got a routine, if you've got a provable thing, you actually have part of what's a blueprint for the next buyer to come in and just basically step in and pay you a proper asset valuation for what you've built. If you don't
And
have
you could
that,
say, and you could sustain the debt payouts if there
yeah,
was
they
going to
can
be there.
prove it,
And,
and
but
they can step in,
well, and I
right?
also think what I love about it, and because like people have hated the word exit for so long, Tom, and like I like it, there's
Okay,
this whole there's a whole psychological
okay,
research paper that I will have behind it. But you're right. What I like about what we've talked about is like if you have a blueprint, if you're doing the framework for planning, doing the forecasting, you can freaking get out of your job and have a president that has that blueprint. You don't have to sell it. You can actually keep your asset, which has a higher chance of outpacing the bullshit going on. So like it doesn't matter what you want to do really, but like the end of the like it doesn't matter what you want to do, but documenting where you are and where you need to be and stress testing it is like it has to be done unless you're going to bamboozle someone into buying your half baked company.
yeah,
Like
which
you know,
happens, yeah. That happens too. But the other thing is, if you haven't done it, you're going to end up selling it to someone who will do it, but they're going to discount you heavily
right.
for the lack of track record, the lack of and their
Well, they don't know
businesses.
what's the risk. They don't
Yeah.
even know. Like, how would a
Well,
buyer know?
and some buyers, if they're in the if let's say they're a family office that and they've been in your industry, they know how things work, and they're going to
Mm-hmm.
discount you, and they're going to within a year, they're going to uh,
Make a lot
um,
of money.
make a lot of money, and they're going to have a valuation that looks very different than from the one that you de facto stuck yourself with.
Well, and so I think going back as we're kind of putting a closing the loop on this conversation, like I think about planning and a framework. Both of those I think are applicable. Like when you say that you're stress tested because you've mentioned that you like other people's ideas, it's not about yours. You don't have a skin in the game, but you're trying to clarify the probability of their outcome. Is that a fair
Yeah,
statement?
yeah. That's
So,
fairer than I think I came up with. That's really good. Yeah, yeah,
um, is it a fair statement that like even though there are other things that matter, like I'm a big conscious capitalism fan of like the stakeholders in your community, especially in your world where there's farmers and a lot like true communities. But like
yeah,
I'd say like it holds absolutely true with all my clients, whether they're
yeah.
employees or vendors, all that kind of stuff. the scorecard that you're helping people stress test against is sustainable free cash flow and working capital and return on asset value.
That's that is in a nutshell. Yeah, that's everything comes to that. Anything else is I don't want to say it's irrelevant, but those
They're
three
byproducts of that. Like right,
yeah,
like
yeah, the
when I think about,
byproduct thing. Yeah, yeah,
it's like it's first principle, right? Because like you could take someone's idea and say, all right, Ryan, you want to do $10,000 an acre. Whatever my ideas are, it's not no, it's just put those in and then be like, dude, you don't make any money. Okay.
yeah,
Do you still want to do it? Go for it. But like at the end of the day, cash flow and then like the right working capital to generate more cash flow and more equity is the only thing that matters in the game of capitalism. And you're either
yeah,
doing that or not.
yeah, yeah. Well, yeah, yeah. Asset valuation is either an anticipation of future cash flow or a pure spec. And maybe there's a place for spec, but if you don't have some reasonable expectation for a pace of cash flows in the future, that's what all valuation ultimately is a reflection of. It's just time compression. Okay, here's what it's worth. This thing stretching out indeterminately, adjusting for all the risk factors as we need to, looks like this number right now. That's what it's worth. If it doesn't match up, then it's probably not a great buy.
I mean, and that right there, I think is the most important takeaways where like, I think that the noise of spec and the craziness of the last 15 years has helped people lose sight of the true rules of the game of capitalism, in my personal opinion.
Well, I mean, I think that's true, and I don't try to prove that to people, except for an early, boots in the ground kind of. But I think you're exactly right, and I don't see a lot of evidence otherwise. Um, yeah, I've seen people who actually were sort of at least tangentially Austrian-minded economists who eventually got tired of being contrarian and being embarrassed, and I think they've I don't know if they're Stephanie Kelton fans or not now, but they certainly aren't Austrian. The whole
Well, it's
modern monetary theory, which is you can cut this if you want to, Ryan, but the joke
no,
is
no, I love it.
MMT is none of it's yeah, wrong on all accounts. It's not a theory, it's not modern, and it's not monetary.
It's just insane. Like you could just print it, it's just fine. It's just like it's so bizarre to me. And like it's as bizarre as the healthcare system of saying you don't need to eat well, sleep well, or exercise. You'll be fine. Just take a bunch of drugs. And it's
Yeah,
like it's just like it's the la la land of both spaces where like discipline, I'm just like, I don't know. It's the world I choose to live in, that like discipline and the way that the world really works will reconcile, and the snap back to it will probably be painful, but the people listening in and unplugging from the matrix are going to benefit. Well, I hope. I mean, like over the long period of time, because
yeah.
like there's a lot of people not paying attention.
No, I think that's so, and timing is always a question, and that's why I have no plans of retiring because I'm not I'm not at all young anymore, and I want to be around to see the other side. So,
And
like
how
you,
fun this can be. Like I think about this, Tom, and like how fun it is. Really hard. Like I think about how hard it has been talking about like over I'll give you two examples. It's hard doing I mean, Charlie Munger or Warren Buffett already have a saying for this. It's really hard doing the right things when everybody else has lost their mind. Like
yeah,
that is how I have felt for 15 years. And like, and it's like, whether it's on the health front or whether it's on the business money front. And it's like, it's really hard doing that, but I'm convinced that the reward will be outsized in the end. And then it doesn't have to be retirement. Like, why would you want to retire if you're having fun working with your clients, right? I mean,
no,
because
no,
when
exactly.
reality, when you're finally right, it's like,
Yeah, I want to hang around for it. So, like you, I try to not as successfully, but I try to look after my health and keep that together because I'm not interested in having to make a forced exit
yeah.
anytime soon.
Tom, this has been fun, my friend.
Yeah,
So
very.
fun. Good conversations. I recommend everybody goes and check out your your blog, like you said, they come out every so often. I got that one and I read it and I was like, this is going to be a fun conversation. So we'll have to keep doing this. Any other thoughts for the listeners?
No, probably, but I'm blanking now, Ryan. Yeah, I don't talk that much except for with clients, and I have spreadsheets and histories open on my browser all the time. So I get talked out faster than I wish was true. So that's what I got today. Yeah.
It's awesome. Thanks so much, Tom.
All right. Thanks, Ryan. Take care.
I hope you enjoyed the conversation with Tom. I love talking about this stuff, and here's why. And even if you geek out on this, or maybe you don't, but why I think it matters to everyone, whether people lean into the topics or not, is because the game of capitalism is more cash flow and more equity. The more sustainable the cash flow, the more equity is there. And the reason we need cash flow and equity is to protect our time. I mean, at the end of the day, we all want to wake up and do whatever we want to do with our time, but we need cash flow, and ideally cash flow that's not tied to our labor, so we can generate equity with that cash flow so we can have more time. And so it's this upward cycle I see. But if money printing is debasing our wealth, effectively our time is getting stolen. So why I care so much about this is because I just want so much independence over my time. And if I can't have independence over my time because what I'm doing every day is being slowly eroded, that matters. And I think we have to all better understand how our time is being spent and how that's generating equity, and whether that equity can generate the cash flow we need to protect our time. And if the game is shifting and things are happening, we're all effectively just waking up and hoping it works. And I think it's important because we should all wake up and we want sovereignty and independence, and our companies can allow us to do that, but we have to measure the right things, and measuring the valuation, the cash flow, and the risk of that cash flow is the right goal. Then it's up to you and how you want to manage your constraints, but have a realistic understanding of the goal and the constraints allows you to be punched in the face and pivot, because you're using the goal and your constraints as a realistic decision-making framework, which is why I like the word framework. So anyways, that's my little 2 cents. I think it's important to constantly be thinking about this stuff. Obviously, we have to take this all into specific action today of like, how are we managing our business and our operations? But for me, it's all about alignment of the little things that I'm doing today tied to the bigger goal. And this conversation helps me, and I hope it helps you. So thanks everybody for tuning in, and I will see you next week.